Hello, everyone. Good morning. Come on in. Welcome. Okay, we've got some people trickling in. Good morning and welcome to The Annual Budget is Over, the new era of planning and forecasting. I'm Tori McBride and I will be your host for today's webinar. While we wait for everyone to arrive, I just want to start off with a quick icebreaker poll. So there'll be a poll launching now asking what is the biggest planning challenge your finance team is facing right now? Click the biggest one. We've got inefficient planning processes, data quality, volatility, compliance challenges, stakeholder management. Let us know. Give you a second to respond. Okay, we've got a range of answers coming through. Brilliant. Thanks, everyone. I think that's quite telling. We're hearing about a lot of these challenges from finance leaders that we're speaking to here at Weel. Okay, brilliant. Well, the good news is that we're going to be touching on each of these challenges today and sharing some brand new benchmarking data so you can see how your finance team stacks up against your peers. But before we do, I'm going to run through a bit of housekeeping. So this session is going to run for about 45 minutes and we do want it to be interactive. So feel free to ask questions, and to do that, just use the Q&A function at the bottom of your Zoom panel. We'll leave about 10 minutes at the end for audience questions. But please feel free to ask them throughout. And then after the session, we will be sending you the recording of the session with a full copy of the report that we're talking about today. All right, with that said, I think it's time for some introductions. So as I mentioned, my name is Tori. I'm a senior marketing manager here at Weel, and I'm part of the team behind the 2026 CFO report. And my role involves putting together events and content that sparks discussion within the finance community. And the conversation that keeps coming up, no matter the audience, is planning. So volatility, currency swings, just a world that isn't sitting still. We're hearing all about that. And we know that the pressure is on finance teams to plan for what's becoming an ever-shifting future. So that's the conversation we're here to have today. And I'm really looking forward to seeing how the data lands with our two fantastic speakers that we have with us today. We have Weel's CFO and COO, Damon Hauenstein, as well as Stian Horne, sales manager at Fathom. Welcome both. It's great to have you here. Could you share a bit more about your experience and your roles? Damon, maybe let's start with you.
Yes, delighted to. Well, look, great to be here. Thank you to everyone for joining and tuning in. Damon Hauenstein, CFO, COO at Weel. My background spent just over 12 years in corporate advisory and capital raising advisory at Citi in the Citigroup in the global investment banking team there. So working with boards, CFOs, CEOs on their often most transformative and strategic decisions. And then more recently, joined Weel and have helped this business scale up and grow as we work with finance leaders and finance teams across Australia and New Zealand. And I think one of the best things about this role is I get to continue what I was doing in my last role, which is working with finance leaders to solve problems and help share learnings and experiences that have worked for others. So yeah, looking forward to sharing some of those learnings here today, Tori and Stan.
Great, thanks, Damon. Stian, over to you.
Yeah, no, thanks, Tori. Great to be here. So yeah, my name is Stian. I lead the SMB customer segment at Fathom across APAC. Day to day, probably spend most of my time chatting with CFOs, finance managers, founders, usually at that point where their current reporting or planning setup just really isn't keeping up anymore. And to be honest, a lot of those conversations, they all sort of start in the same way. It's like we're spending too much time in Excel, or we don't trust the numbers enough to make decisions quickly. And more recently, it's kind of shifted to things are changing too fast. And how do we actually stay on top of it? So yeah, really looking forward to unpack all of that with both you and Damon today, Tori.
Awesome. Thank you so much, both. Now, before we dive into the questions, I just want to give our audience a bit of context about Weel's latest CFO report, Finance After the Pilot, which will be driving our discussion today. So we're going to be focusing on chapter 4 of the report, the end of the annual budget. And this chapter sets out to answer what's actually driving the shift away from static budgets, what finance leaders are doing differently, and what's still getting in the way for teams that haven't made that transition yet. So, Damon, I wonder if we could start with you. Maybe you could tell us a bit more about the report in general and which findings stood out to you from this particular chapter on planning.
Yes, so this is a very important report for us. It's the third consecutive year that we've run it. And the reason I highlight that is as you do more of these reports and you ask similar questions year on year, you get some really great data you can compare and contrast and ultimately makes it more meaningful. So third year we've done it. This year we spoke to over 250 CFOs, finance leaders across both Australia and New Zealand. Really interesting findings, which we'll dig into today. I think the biggest thing, though, that stood out to us when we looked at it, and I called Tori when she sent me the first set of data just to make sure this data point was correct, was that almost 100% have actually changed their approach to planning in the last 12 months. I think that is huge. That is, it shows that universally this is a focus across the market. And I think it says a lot about what we're seeing in the finance landscape and the market generally. You've got macro drivers, you've got tariffs, you've got currency, you've got oil, commodity price volatility. So I think because of that, everyone is suddenly thinking, what does that mean for my planning cycle? Am I actually set up to drive the organization and to account for the changing world around me? And I think, sets us up for a very interesting discussion today.
Thanks, Damon. Yeah, I think that 96% blew us all away. It's not often that we see a consensus that strongly in our data. Based on that stat, Damon, do you think that the annual budget as we know it is over?
Well, look, I think no one has ever liked the annual budget cycle generally. So I think people have wanted it to be over for a long time. I think the challenge has just been how do you move to something that is more frequent or something that is more evergreen in the organization. I think that is a hard place to get to. But I think certainly our data this year shows that many are thinking about it, many are trying, and when we go and talk to people, this is definitely evident across the market. So maybe if we just unpack what are some of the things that are driving that. Cost is a big one. So I think in a global setting where you are seeing so much volatility around costs, and oil prices is probably the big one at the moment that touches so many industries, some directly, but many indirectly through second order costs. It is hard to predict what that is going to look like 12 months out, let alone 6 months out, let alone 6 weeks, 6 days. It's like it is really hard. So I think that is the big one. I think another trend we are seeing is that more of the CFOs and finance leaders are taking greater degrees of ownership of organizational strategy. And I think as they increase their remit, the expectation around how much of the wider organizational context is taken into account in the forecasting increases. So in a world where finance is like a very narrow thing and they're just taking inputs from others and preparing a model, maybe the annual thing works. But where the CFO is now more integrated into the overall organizational decisions, there's an expectation that their forecasts are more accurate. And then look, the last point maybe just to call out is that going into the year, despite the fact so many people were looking to revisit it, we found that around 95% still felt confident going into the year. So I think this is really interesting. I think this is where you start to see the benefit of tooling and infrastructure that people have set up come into play. Because I think in order to have that confidence going into a period that's so choppy, so volatile, you need to be confident you've already got some really good systems and process in place. And when we go and talk to finance leaders, a lot of them have been thinking about this for a long time. A lot of them have already put the pieces in place, which is really great to see, and therefore they get the benefit from that today. And I think that in part is why, for this webinar that you're all listening to now, why we had such strong interest and attendance today, because it is such a topical concept.
Thanks, Damon. Stian, how does that land for you? Does that match what you're seeing across Fathom's customer base as well?
Yeah, I mean, very clearly, to be honest with you, I think while that 96% stat is high, it doesn't really surprise me all that much. And because almost every conversation that we're having right now starts with some sort of version of, the plan that we set just a few months ago just doesn't reflect reality anymore. And it's not so much because, finance got it wrong, but to Damon's point, like the environment is just changing constantly. I think we see this probably more in things like, multi-entity businesses, scaling companies, and particularly businesses with tighter margins. Obviously, just because they feel that change faster and that impact tends to compound quite a bit as well. And I've sort of seen recently that there is kind of this clear trigger moment, I think, for a lot of these teams. And it's usually when they've been in that leadership meeting and someone has asked, can we afford to do this? Can we afford to do X? And finance finds themselves in a position where they either can't answer that quickly or they can't answer it confidently. And that's really where they see that annual budget start to break, right? So I'd say like it's not so much that the annual budget, like it doesn't fail because it's wrong, but it fails because it's too slow to adapt once it actually does become wrong.
Yeah, I think that's definitely true. I think we're all aligned that the annual budget just is not keeping up. So I want to ask you, Damon, if the annual budget is out, what's taking its place?
Yeah. So I think organizations will still think about things annually. I think that is a truism. If you think about strategies, if you think about just salary reviews, and there's just so much of the world that is set up on an annual basis. So I think people are always going to think about the business annually, but I think what happens instead is that organizations, finance teams, are now just thinking about the forecasting and the modeling more frequently. I think that's what's happening on the ground. So a lot of organizations without the infrastructure would put off things like budget reviews and reforecasting because it's just too hard of an exercise to do. And they'll just run the full year and say, well, we haven't done a reforecast. We kind of know we're not on track to hit the numbers, or the numbers are going to be off by some degree, but we don't have the time or resources to go through that full reforecasting exercise. So yes, I think what starts to happen now is that people do that exercise. They sit down, they update the numbers, they talk through the inputs, they generate a revised set of numbers, and they share that with the board, with the management team, and everyone is now working off a much more accurate outlook on what the business trajectory looks like. And that is important because everyone can then make much better decisions off the back of it. That's kind of the implication. So what do you need to do to make that happen? Well, it's a bit of a continuous loop that gets set up, really. You need to have that loop where you're planning, you're monitoring, you're adjusting. It's when it's at its best, it's effectively a rolling forecast where you almost like take out the quarterly, monthly, weekly sort of milestones in it, and the forecasts are kind of just evergreen things that live in a dashboard. People can open them on demand at any point that's needed. And if inputs assumptions are changed, they are just rolled through automatically. That's what we see the best teams doing. It's a harder state to get to. It requires a lot of coordination between people, processes, tooling. But many teams successfully pull this off and reap the benefits from this in a big way. So look, for finance teams, yeah, what does this mean? I think increasingly the expectation from stakeholders, investors, boards, counterparties, is that each organization is moving much closer to that real-time continuous forecasting. And that means, yes, if you're in a finance seat today, that is the thing that you increasingly need to be thinking about, because the world is shifting and the expectations are shifting. Now, it's not going to get there overnight. No one's looking for this tomorrow, but I think increasingly people will be asking the questions on, if you're not doing it, why aren't you doing it? What is holding you back from doing this? I think the tools are coming a long way, and yeah, Stian can talk about this much more eloquently than I can. But the tools are coming a long way. I think people also see the potential with AI and with coding tools. A lot of people are experimenting with these things. I think a lot of people now see the potential and the opportunity here. So yeah, I would just summarize it up as, is the expectations are changing, people's historical perception of what was blocking them, I think, will be more open to challenge today, because I think so many people in the more senior roles, boards and investors, are now seeing what the yellow brick road looks like and encouraging people to test, experiment if they're not already on this path.
Thanks, Damon. Stian, I want to hand over to you. I know you work with a lot of teams, finance teams, that are going through this exact challenge. So what does it actually look like for those teams that are, moving to rolling forecastings? What does it look like in practice?
Yeah, I mean, to be honest with you, right, I don't think most teams just sort of switch to rolling forecast. They tend to sort of drift into it, for lack of a better term. That usually starts with maybe reviewing things a bit more often, and then starting to tweak assumptions mid-cycle. And then at some point, the forecast just really becomes something that you update whenever something changes. So it's less of that sort of big transformation and more just a shift in how team works. And where it either sort of works or falls is really the structure, because the teams that get it right, they tend to have kind of that one core model that's just always live, right? The actuals, they flow in, and instead of having to rebuild everything, they're just sort of adjusting those key drivers. And those updates are then, well, usually triggered by something happening in the business, not because it's month end, quarter end, or a new year. So day to day, it's actually pretty simple, right? Because you're not rebuilding models, you're updating assumptions and letting actuals come through and running, scenarios when someone asks a question. So finance in that scenario, they don't tend to then have to really, go quiet for a day because they then have to go and rebuild something, but they're more part of the conversation as it actually happens. And I saw this. I had a pretty good example of this with a hospitality group that I worked with recently, rather large, 20 or so venues. They had, supplier costs were moving and there was margin pressure. And there's just this like constant questions around hiring, and should they open a venue? Should they be closing a venue? And in something like, say, Excel, which I still think a lot of teams tend to sort of go to first, every one of those questions meant copying the model, updating the inputs, checking that everything is still working. And that chews up easily a full day just to answer one question. But the issue here, right, was that these questions, they weren't happening once a quarter. They were multiple times a week. So by them sort of moving to a rolling forecast, they could just keep that one live model, right? Having those actuals and those assumptions sort of continuously flowing in, tweaking the drivers around labor or pricing or expected revenue per venue or whatever else it might be, and then just run those quick scenarios on the spot. Do we hire now or do we hire later? Do we delay an opening or do we do it now? Do we absorb that cost increase? Just really whatever it was. So yeah, I think instead of going away and sort of coming back a day later, they are now sort of able to show that impact there and then. And I think that's really that shift, right? It's not just about updating numbers more often, but it's really just about having something that you can actually use when decisions are being made and not after. That's sort of that big shift.
Thanks, Stian. Yeah, I think that's a great example of just how important live data really is when it comes to accurate forecasting. I want to turn now to another headline that came out of this chapter of the report. Another shift that was surfaced was around scenario planning. We found that 51% of respondents said that they placed more emphasis on scenario planning this year, and that figure rose to 60% in New Zealand. So Damon, I want to ask you what you think is driving this shift towards scenario planning.
Yeah. Well, look, I think it's as simple as the world is just a much more complex and unpredictable place than it was maybe 12 months ago, maybe 2 years ago. I think as the world becomes less certain, people want to do more what if analysis to understand what might happen. And I tend to find people are more interested in this where there's like one or two bigger macro themes happening that people can get their head around. So I think that's pretty clear at the moment. You've got the war, you've got multiple wars actually, but one war that's particularly having an impact on the Australia, New Zealand part of the world in what's going on in Iran, because that has implications for oil, and oil has so many first and second order effects across the economy. So that's probably the big one that a lot of people are thinking about. That then has implications for things like interest rates and growth, market-wide. So I think that's what's really brought this to the forefront for a lot of people. And I think, yeah, the reason this becomes relevant is because so much of it can be a little bit binary in terms of where it goes. Like we may have a scenario where the war is resolved, oil prices trend back to historical levels, and we carry on. We may equally have a scenario where things stay where they are or escalate, and oil prices stay high for a long time, and people have to contend with that. So I think that is like a big, if I was to internalize the data and the results, I think that is a big part of it. I say that's just different to other periods where you've got lots of little niggling things happening, but no big macro event. So when you have that, I think the question comes up from boards to management teams, and they say, how are you thinking about this? What are the scenarios you are looking at, thinking about? Are you prepared for it? And look, I think on this front, expectations are shifting as well. I think people in governance, shareholder roles are looking for more sophisticated, more considered analysis around the different scenarios. And there's a practical reason for this, because if you've thought through and you're able to model out those different scenarios, you can ultimately do better planning and contingency and preparation for those scenarios. So that's why everyone's so focused on it. I'd probably just then tie it back to my earlier comment around CFOs taking on broader responsibilities in the organization. As the CFO has a greater understanding of what's going on in the organization, the expectation around what is considered in that scenario planning increased as well, which kind of ties back to the earlier point, which is you need good tools and capabilities and systems to be able to run that scenario planning. So yeah, that'd be it in a nutshell, Tori. I think big macro trends mean that people want to see the different scenarios play out in addition to all the smaller scenarios. And then you need the tooling and the skills and the processes in order to come back with effective scenario analysis.
Thanks, Damon. Stian, we've talked about the kind of macro drivers of what's leading this shift, but what does good scenario planning actually look like in practice, for finance teams? How many scenarios do they need? How often do they need to be reviewed? Who's involved? Break it down for us.
Yeah. So, I mean, yeah, there's obviously sort of more than one reality here. But I do think that this is where a lot of businesses are still catching up, because similar to what Damon is saying, like, most businesses today probably usually just plan for one reality, right? It's like revenue does X, cost does Y, and then if that happens, we land at set somewhere. And to his point, right, the reality is that these things never really play out like that. And most of these forecasts wouldn't fail because they're wrong, but they fail because they only assume that one outcome. So when it doesn't, that means stress in the business, because now we're ending up having to react in real time. So, like I said, I don't think there's a golden rule, but what we see the most in customer conversations is that there's a shift towards planning for, at least three realities. So you got the base case, you have the downside or worst case, and then the upside slash best case, whatever you want to call it. And the key difference really isn't that they're not just modeling those scenarios, but it's about deciding in advance, right? If this happens, what do we do? If revenue goes higher than expected, where does that capital go? Or if costs increase, then what do we flex? Or if demand slows, then what decisions can we make early? So a phrase that I often use here is sort of that classic, plan for the worst, sort of plan for the best, but prepare for the worst. Because again, it's not about predicting necessarily one future, but it's being prepared for multiple. And I think a lot of the time, a single forecast can create this sort of illusion of certainty, whereas a good sort of process around scenario planning, that's really what creates confidence. So, and to your question, like around what that actually looks like in practice. So, like I said, most teams will tend to land on around sort of three scenarios. That tends to be enough. Sometimes adding more can just sort of be unnecessary complexity. But again, it's not necessarily a golden rule, right? I worked with a fuel distribution company, right, like a few weeks ago. They were running something like 20 scenarios at the moment, right? Because there's so much uncertainty in that particular industry, right? And that might be the case for a lot of businesses as well. Maybe you run three scenarios for 80% of the year, and then in that sort of peak season, maybe you up that to like 5, 6, or like these guys did up to 20, right? The cadence question is a bit more of an interesting one, because that's changed quite a bit. Because like it used to be maybe a once a year, once a quarter sort of board exercise. And now it's really something that we see teams revisit simply whenever assumptions change or decisions need to be made. So it goes from being kind of less calendar driven and more event driven. I think you had in there as well, sort of who's involved in this process as well. And I think, that's always going to be like the best teams are the ones that bring in the business, right? They bring in the operations and they bring in sales and they bring in management of different departments, because these finance teams, they know that they're not the ones that own the inputs. They're translating those inputs. So you need the people in the room that actually own those inputs as well. And again, like practically, like how teams actually do this, I think this is usually where tooling becomes important. Because this is just about like if running a new scenario means that you have to rebuild a sort of call it manual model, people aren't going to do it, right? There's too much going on. Like people aren't going to spend the whole day to rebuild a model in Excel just because a manager of a certain department wanted to see the effect of X on Y. So, and I think that's what tools like Fathom really allows you to do, right? Because you can take things like a base forecast that's already live and rolling. You just simply layer in those changes like the hiring and the cost shifts and the new initiatives. And then you just simply spin up those versions of that forecast, those new iterations like that when the conversations is happening. So yeah, I think that hopefully sort of answers your question there as well.
Yeah,
And
it does.
Tori, maybe just to build on one thing Stan said, I think in terms of the timing, like it can vary from one period to the next depending on what's happening in the organization. I think, if you pick COVID, for example, right? Like no one knew when that was going to happen. There was very little warning when that hit. And so that, changed things for a lot of people. I'd say even, what happened in Iran caught many by surprise. And so you may have periods where there's no need to adjust forecasts and scenarios for a long period of time. Then you may have a period where everyone's focused on it and wants it done weekly or monthly or quarterly for a period of time while there's a whole lot of volatility, and then maybe you go back to the old cycle. And so I the takeaway from all that for me is you just want to make sure you've got the tooling and infrastructure and processes in place so that if you need to do an ad hoc report or if you need to bump up the frequency for a short period of time, you're ready, willing, able to do so. Equally, maybe the best thing is you don't need to do it at all because everything tracks to forecast and it's happy days. But yeah, it's just that agility factor I think is really important.
Thanks, Damon. Yeah, I want to hone in on that idea of agility. We've talked about continuous planning, but continuous planning demands this also continuous data. And what we found in the survey was that data accuracy ranked as one of the top two concerns amongst finance leaders at 38%. Damon, how do you reconcile finance teams wanting real-time data, but not fully necessarily trusting it yet?
Yeah, well, I think both things can exist at the same time. I mean, it is a want. People want accurate data and they want systems to be in sync and they want everything to line up. And if you can achieve that state, that is when you get the best results from the tooling and the forecasting and the systems. So I think both can coexist. People, the best teams have already done a lot of the hard work to get the data into a good place, and it's often a lot of hard work, a lot of hours to achieve that state. Once they achieve it, they realize the benefits. You can automate more, you can do things, you can generate reports, scenarios, forecasts much quicker because you're working with accurate data. But the reality is, for most organizations, there is still challenges with the data or just pieces that have just never got the prioritization to clean up and fix. And so what happens is each time these exercises come up, it is a little bit of a human trade-off where you are trying to balance that agility and that desire to get something out quickly with knowledge that there are bits of the data that are imperfect. And I think this is probably an important part where the human judgment is still really important in the finance role. We talk a lot about AI systems automating things, but often some of the biggest decisions are, I think this is 80%, 90% of the answer for 10% of the work. Is that appropriate for this exercise, or do I need to get it to 100% accuracy, which is a lot more work? And I think that is where the best finance teams, the best finance leaders, that human judgment plays a big factor. So yeah, I see this play out all the time. Actually, even in our own organization, there will regularly be requests for ad hoc data points, and it's just balancing that effort with what is the size. Sorry, balancing the effort with what is the actual benefit that comes from getting it more accurate.
Thanks, Damon. And Stian, what would you say is the most common data quality issue that you see in the Fathom world that undermines forecasting accuracy, and what can teams actually do to fix it?
Yeah, I mean, I feel like I have to sort of mirror pretty much exactly what Damon is saying here as well, right? Like that whole idea of, at least from my perspective, and this might be an unpopular opinion to be fair, but perfect data too late is always going to be less useful than imperfect data you can act on. And I think a lot of the time, the challenge is less necessarily about data quality and maybe more about how finance teams, again, think about accuracy. We all hear that sort of pain, and that's probably been sort of in the market for years and years, where it's like, oh, we have data sitting in accounting systems, and some of it is in spreadsheets, and some of it is in operational tools, and nothing is connecting properly. So that the finance teams usually spend so much time on just pulling data together, reconciling, checking consistency before they ever actually get the chance to start analyzing. And to be honest, that is a giant blocker if you're trying to move to continuous planning, because that whole system depends on speed and trust in the data. And there are a few things that we see, right? Like simple things that I think a lot of businesses can do, like simplifying the structure, right? Like having a clean chart of accounts. If you're running multiple entity, aligning entities in the chart of account structure as best as possible. Standardizing the data, consistent categorizations, consistent updates, reducing as much manual handling of, again, connecting systems where possible. Like those are sort of those simple things that I think a lot of businesses can do, and we see more and more of. But yeah, again, don't stress too much about every data point having to be perfect. Have it, good enough so that you can go and actually make decisions off the back of it. That is so much more valuable.
Thanks, Stian. Now, I'm aware we've got about 10 minutes left, so this is just a reminder to our audience that if you do have any questions for Damon or Stian, please drop them in the Q&A, and we'll be getting to them in just a moment. But before we do, I've got a couple more questions for you. Damon, 53% of finance leaders, according to the report, said that collaboration with budget owners has increased in the last 12 months. But we know that getting that buy-in is not always easy. So I want to ask you, do you think the shift to continuous planning is more of a tools problem or a people problem?
I don't think anything has changed here. I think the importance of human relationships and communication with the other humans in the organization has been very important historically. I think it is very important today in an era of AI and automation. For finance leaders, I do think they need to take the time to build those relationships, to build that rapport, to earn that trust, because if you've got those pieces in place, all this becomes really easy. And when that is lost, doesn't matter what tooling you've got in place, it's just going to be a hard exercise. So yeah, I don't think a lot has changed here. If anything, I'd say this is probably more important than it was in the past, because I think there's a lot of often false confidence in organizations that the AI generated report or tool or thing has the right answer. And yeah, you need to be able to sense check that. You need to be able to talk quickly with the people that actually are on the ground using that tool or closest to that data point, just to make sure the thing that is flowing through the more automated systems is actually accurate. So that, yeah, I think it's just important, if not more, today.
Thanks, Damon. Now, this is going to be my final question for you, Damon. If you had to pick 3 key learnings from the report that you think finance leaders should apply to their planning approach for the rest of this year, what would those 3 learnings be?
Yeah, okay. Three things. Look, so we talked about this a little bit beforehand, so I will share them on screen as well. I think one is, as the remit and expectations and responsibility and ownership of that CFO role grows, I think so too does the need to have that always on forecasting. For the reasons I mentioned, I think people just expect those leaders to be across more of what's going on in the organization and be up to date with the pulse. We talked about the importance of those relationships. So I don't think it's purely a finance function or a finance responsibility. I think finance is the owner, probably the ultimate owner. The buck has to stop with someone. I think that is still finance, but this is where the importance of those relationships comes into play, because you can only realize this if you've got those relationships and you can work with people to get the inputs from their relevant functions, or just to sense check the numbers you're generating. And then finally, yes, I think fixing the data before you start the process just makes all the world of difference. I think it is a judgment call on like what degree of fixing you get it to, and I think that's unique to each organization, like what standard or what data points are critical. So I think that's a big judgment call. But I think the exercise generally of taking the time to take stock of where your data's at, what's plugged into what, where are the big gaps is a worthwhile exercise because you will get so much more leverage out of the planning process if you've got the core pieces in place. So yeah, that's three.
Thanks, Damon. It's a tough choice between all those learnings, but those are great. Thank you. And one last question for you, Stian, before we move on to the audience Q&A. Based on what you see across Fathom's customers, how do you think finance leaders can set their team up for more confident, agile planning in 2026?
Yeah. So I mean, this will probably be sort of more summarizing what we already talked about, but yeah, I do think it's about sort of taking a more holistic approach to all of it, right? It's not just going to be mindset or process or tooling in isolation. I think it's really whether the finance team has actually repositioned itself in the business. Because, like the teams that are still struggling tend to operate like we talked about. Like they produce a forecast, they review it periodically, and then they go ahead and report on the variances. And that just means that forecasting is still sitting alongside decision making. Whereas what we typically see in, call it like best in class forecasting or planning, is that the teams have really flipped that, right? The forecast is at the center of the decision making. It is what gets used every time something comes up, or at least something major comes up. And you see it in how those conversations happen internally, because it just shifts that from, oh yeah, we'll look at that in the next planning cycle. It becomes, yeah, okay, let's run it through the model and see what it does. So I think that's really the shift. Again, it's not more frequent planning necessarily, but it's just planning being pulled into a lot of those live decisions. So I think for finance teams, that just means that there's less about adding another process and just more about making sure that the model is actually usable in the moment, something that the team can trust and update quickly and bring into conversations. Because when that happens, you sort of get the speed and you get the ownership sort of broadens to more than just finance. So look, if I had to simplify it, I think the question is really, right now, is your forecast being used when decisions are being made or after? Because if it's after, it's not influencing anything, right? That's just, yeah.
Brilliant. Thanks, Stian. Okay, we've got a little bit of time now for audience questions. You've had a couple come through, so I'll just field these to you both. Let's start with this one. How do you get budget owners genuinely engaged in planning, not just handed a template? Maybe Damon, I'll throw this one to you.
Yeah, so I actually think in an organization, most people are interested. Most people do want to add value to the budget, to the forecasting process. They often just don't know how. They often don't have the context or the understanding of what the process that the finance team undertakes is or looks like or how it's used. And therefore, there's often some degree of apprehension or nervousness to actively participate in the process. So, what does that mean? I think it means if you're in a financial leadership role, there is a responsibility and onus on you to go out to engage with the teams to explain what that process looks like, how it plays out, where, what are the inputs you take in, what do you do with those inputs, what are the outputs and where does that go? I think once people understand that, they're much more open, willing, enthusiastic to engage. But it often doesn't happen overnight. So I'd say it's an education process, and I'd say for the most part, it really sits with the finance team to drive it because it's almost the information's in their head, so the onus is on them to help get it out, disseminate it. But I think, and we've seen this in our own organization, Tori, I think once you start that education process yeah, people are enthused, engaged, and participate.
Yeah, absolutely. Stian, final one for you. For teams still relying on annual budgets, what is the single first step that you'd recommend to transition away from those?
Oh, yeah, look, I think it is really just the fact that most teams try to go from 0 to 100 just way too quickly, like replace the whole planning process in one foul swoop. And that's usually where we, at least from our perspective, see that it breaks the most because, people are naturally resistant to change and especially when it disrupts how they work. So I think the real issue usually isn't like, oh, we need a rolling forecast. But it's that finance, again, can't keep up with the pace of those internal conversations. So I think I'd start there, right? Like pick one decision in the business that keeps coming up, if that's hiring or if it's opening a site or if it's pricing. And whatever you want to use, like just build something that lets you answer that in the shortest amount of time possible, right? Because again, if you can't keep up with that conversation, then the business will eventually just stop waiting for finance to catch up. So yeah.
Yeah, really well said, Stian. I think that's a great note to end on. I want to throw out a quick poll now before we wrap. So if you did feel like today's session resonated with you and your team, and you'd like to hear more from either Weel or Fathom, please let us know in the poll that's launching now. I'll just give you a minute to respond. And while you're answering that, I just wanted to say thank you again to our speakers today, Stian and Damon. It's been so great to have you both here sharing your expertise. To our audience, we really hope today gave you more of an inside look into this new era of planning and forecasting. And just a final reminder to keep an eye on your inbox after this session. You'll all receive a copy of the CFO report shortly with all the findings and more. So that brings us to the end of today's session. Thank you so much. Thanks, Stian and Damon, and we'll see you at the next one.